Hey everyone, and welcome. Today we are diving deep into the world of UK property investment, specifically for those of you watching from around the globe. We're going to break down exactly how you can use a special kind of loan to build a property portfolio right here in the UK. So let's get right into it. So let me ask you a question. Have you ever thought about earning a steady, passive income in one of the world's most stable currencies, the British pound? Well, for a lot of international investors, UK property is an absolutely fantastic way to do exactly that. It can be a great way to diversify and protect your wealth. So here's our game plan. We're going to start with the basics. What exactly is a buy-to-let mortgage? Then we'll tackle the big question. Can you even get one as a foreign investor? After that, we'll decode the real costs and rates, weigh the pros and cons, and then wrap it all up with a final checklist to get you started on your journey. All right, first things first, let's really get to grips with the main tool you'll be using for this kind of investment, the buy-to-let, or as you'll often hear it called, the BTL mortgage. So a buy-to-let mortgage is a loan designed specifically for one thing, buying a property that you plan to rent out to tenants. Now, here's the absolute key difference. The lender is way less interested in your personal salary and much more focused on the rent the property itself is likely to generate. It's looked at as a business investment. Plain and simple. And this slide really nails that difference. When you buy your own home, the bank looks at you, your job, your personal credit score, your finances. But for a buy-to-let property, they're looking at the asset. The big question they need answered is, can this property pay for itself? So how do they figure that out? Well, they use this magic number called the interest coverage ratio, or ICR. Basically, lenders need to see that the rent you're going to get each month will cover the mortgage payment by about 125 to 145%. So if your mortgage payment is £1,000, they'll want to see rent of at least 1,250. It's their safety buffer, right? It just makes sure the investment is solid. Okay, so you get the concept of a BTL mortgage, but how does this all work for you as someone living outside the UK? Let's tackle that head on. And this brings us to, let's be honest, the million-dollar question for most of you watching. Can someone who doesn't live in the UK, a foreign national, actually get one of these mortgages? And the answer is a big, clear yes, absolutely. The UK property market is actually incredibly open to international investment. But, and this is a really important but, the process isn't the same. The rules are definitely stricter, and the bar is set higher than it is for a UK resident. Let's look at the key things you'll need to have lined up. For starters, expect to put down a bigger deposit. We're talking 25, maybe even 40%. You'll also need to work with specialist lenders because your typical high street bank often won't deal with non-residents. And get ready for some serious anti-money laundering checks. You'll need crystal clear proof showing exactly where your deposit money came from. Okay, let's talk numbers. What's this all actually going to cost, and what kind of interest rates should you be expecting to see? If we look at some typical rates, you can see that foreign investors are actually in a pretty similar ballpark to UK residents. That said, you should probably expect to pay a little bit of a premium, maybe 0.5% to 1% higher. It's just how lenders account for what they see as a bit of extra risk. But the interest rate is only one piece of the puzzle. Your biggest upfront cost, by far, is going to be that deposit. But you've also got to factor in taxes, especially something called stamp duty, plus all the fees for the mortgage and your lawyers. And don't forget, any profit you make from rent or when you sell will be subject to UK tax. And speaking of taxes, this one is a biggie. You absolutely have to remember this. As a non-resident, you will pay an extra 2% surcharge on the stamp duty land tax. To put that in perspective, on a £300,000 property, that's an extra £6,000 you've got to find right at the start. It has to be in your budget from day one. So when you add up all these costs, you have to ask, is it actually a good way to generate passive income? Let's break down the good versus the not so good. Look, the upside here is huge. You get to use what's called leverage, using the bank's money to control a much bigger asset than you could buy with cash. And you've got the potential for both monthly income from rent and long-term growth in the property's value. But, and it's a big but, the risks are very real. Interest rates could go up, taxes can eat into your profits, and you might have void periods with no tenant and therefore no income. It's not a guaranteed win. Now, this is one of the most important strategic choices you'll make. How do you actually own the property? If you buy it in your own name as an individual, you can no longer deduct your mortgage interest from your rental income for tax purposes, which, frankly, can be brutal. But if you set up a limited company and buy it through that, the interest becomes a fully deductible business expense. For most higher earners, the company route is way more tax efficient. Phew, we've covered a ton of ground. So let's pull all of that together into a nice, clear final checklist to help you figure out your next steps. Okay, here's your path forward. Step 1, and this is maybe the most important, partner with a specialist mortgage broker. Don't try to go it alone. Step 2, run the numbers like your life depends on it, every single cost, every fee. Step 3, understand your legal duties as a landlord in the UK. And finally, before you do anything, and I mean anything, get professional tax advice that's tailored to you. Seriously, that part is non-negotiable. And so that brings us to our final question, really, for you. With its potential for stable returns in a major global currency and with a clear, though challenging path for international investors, could a UK buy-to-let property be the engine that powers your passive income goals? The opportunity is definitely there. But the key, as with any great investment, is all in the preparation. Thanks for joining me for this explainer.